Hello, I'm Russ Mould, AJ Bell's Investment Director, and welcome to the latest edition of Fundamentals, where I'll be looking at the second most popular investment trust on the AJ Bell Youinvest platform at the moment, namely Scottish Mortgage. This closed-ended vehicle is managed by Edinburgh fund management group Baillie Gifford, and it's a giant with over £3 billion in assets. Scottish Mortgage, despite its name, lies in the global sector, and its mandate is to maximise total returns for investors through a combination of capital and dividend growth. Fund managers James Anderson and Tom Slater own just 54 stocks, and the top 10 represent more than half of the portfolio. So this is a very focused fund, and it's one where ultimately growth stocks are preferred. Note that 47% of the assets are in tech and healthcare companies, as this first chart here shows. The emphasis is therefore on capital growth, but do note the investment companies offers a yield of around 1.2%, paid via an interim and a final dividend in June and November. Again though, growth's really the emphasis. Anderson and Slater seek out firms whose competitive advantage means they have the potential to be long-term winners, and by long-term, they benchmark their performance against that of the FTSE All-World Index on a 5-year rolling view. Note that top 10 holdings include Amazon.com, Facebook and Alphabet, the parent of Google, as well as US biotech player Illumina, electric car maker Tesla, and Chinese internet stocks Tencent and Baidu. The fund's built stock by stock, bottom up, with no desire to mirror the weightings of any benchmark. But for those who would like to know, this means the USA is the largest geographic position, followed by Asia and then the Eurozone. So, that's the mechanics. The question now is, why would investors be thinking of buying today? Okay, well, I think there are 4 possible reasons why Scottish Mortgage is proving popular right now. First, we do seem to be stuck in this low growth world. Yet here we have an investment trust which specialises in digging out long-term growth winners, which may tempt patient long-term investors who are particularly seeking capital growth. Second, Scottish Mortgage is a global fund. Only 8% of its assets can be found in the UK. If anyone's frightened of a Brexit vote on the 23rd of June and fears sterling could go down as a result, and nobody knows, this would be one potential way of hedging against that, as weakness in the UK's currency would increase the value of Scottish Mortgage's overseas holdings once their value is translated back into pounds and pence. Third, while we must note the past is no guarantee for the future, Scottish Mortgage does have a proven track record. As we've already seen, the long-term dividend growth profile is pretty good and the capital growth record is excellent. Data from Morningstar show that the investment trust ranks second out of a group of 28 in the global category over 10 years for performance and third over 5 years. Data from the Association of Investment Companies revealed that a £100 investment 10 years ago would be worth $328 today, and that's before any dividend payments. Only Linsell Train can beat that in the global category. Finally, Scottish Mortgage has a relatively low total expense ratio of just 0.48% a year. The global sector investment companies charges 0.73 on average, and only 2 global rivals come in below Scottish Mortgage. Baillie Gifford clearly knows that costs compound up just like dividends, except costs erode returns rather than enhance them, so they're clearly doing their best to keep investor expenses to a minimum. Now, Scottish Mortgage may not suit everyone's investment goals, target returns, time horizon, or appetite for risk. Only you can address those questions for yourself. And do note, it can be a volatile share, given the tech and biotech exposure and its current 10% gearing ratio. The final chart for the last 12 months of the investment company's share price does show performance has been choppy, while the investment trust also trades at a small 2% premium to net asset value at the moment, something else you might like to consider when you research it. So thank you for watching, and I look forward to seeing you next time.